Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. Municipal bonds, which are often federally tax exempt, can be attractive investment options for investors in higher tax brackets. However, municipal investors often make common mistakes. So here to help me discuss a few of these mistakes and how to correct them is Portfolio Manager and Chartered Financial Analyst Travis Dragan. So Travis, where do we get started?
Well, one common mistake municipal bond investors often make is waiting to get invested until the Federal Reserve has clearly indicated that they're done raising interest rates. By not investing, those investors forego receiving interest while they remain uninvested. And because financial markets tend to be forward-looking, muni bond yields tend to peak prior to the Federal Reserve actually providing that indication, according to Charles Schwab.
Yeah, and investors instead may want to take advantage of some of the higher yields offered by municipal bonds over the last decade and get invested and start earning interest now.
Exactly. And investors also tend to overinvest in their home state, which can provide income that's state tax-free as well.
Yeah, however, in our experience, investors can often obtain higher yields and improve diversification at the state and municipal level by including municipal bonds outside of their home state.
That's right. And another mistake investors often make is viewing the entire municipal bond market through the lens of one single issuer or a very small group of securities, when in reality, the muni market is a vast set of investment opportunities for those who are willing to look.
Yeah, and there's really over 50,000 options out there, so it's incorrect to assume that every issuer faces the same challenges or the same opportunities.
And that's why doing the analysis and doing your homework is incredibly important for selecting municipal bonds that are going to perform well over the long term.
And one of the pros of municipal bonds, possibly the one that really gets the most attention, is that they can be triple tax-free, meaning that the interest earned is exempt from both federal, state, as well as local taxes.
Right, and that's an incredibly important point for individuals in high tax brackets. So for example, investors in the 32% tax bracket and above, municipal bonds offer a higher tax equivalent yield than corporate bonds currently. However, that comparison is always changing with interest rate fluctuations, especially in a rising interest rate environment.
Yeah, so if you look at a quick example, if you have a municipal adjusted yield, it could be around 3%, but maybe the corporate bonds are only paying 2.7% for those in the higher tax brackets. So your tax bracket may change though as well, so whether it's increasing or decreasing, you should consider the tax bracket you're anticipating with the purchase of these municipal bonds.
And the final piece to consider are the risks involved, which are interest rate risk and credit risk.
The bottom line is that municipal bonds can work for you in the right situation, especially for those in the higher tax brackets. If you have questions about municipal bonds in your portfolio or any fixed income strategy, we're here to help. Give us a call. Here's Fox News Sunday.